What is going on, guys? Nick here, back with another video. Verizon stock has long been a staple of most dividend investors' portfolios. A stable company with a strong moat and a clear future. But over the past year, Verizon stock has slowly sold off, while the rest of the market has risen. So in this video, I thought I'd take a look at Verizon stock and figure out what's going on, and decide if now might be a good time to buy Verizon stock. So what's going on with Verizon? Well, for the last decade, Verizon's been looking for ways to grow their business. While Verizon leads the wireless provider subscriber count with 121 million subscribers, Verizon has seen extremely slow revenue growth, averaging only about 2% growth over the past decade. It's hard to get customers to pay more for their phone bills, and there's only so many wireless subscribers out there to be had. So in 2014, Verizon came up with a new strategy in their search for growth. They decided to buy AOL for $4.4 billion and then Yahoo for $4.5 billion. Their plan was to add a media arm to their business where users could stream internet content through their Verizon subscription. The plan sounded a lot like a lot of the streaming services that have popped up over the past couple of years. But Verizon's vision of their $9 billion media segment purchase never came through. And earlier this year, in September 2021, Verizon spun off both Yahoo and AOL into a new company for about $5 billion in cash, a little over half of what they originally paid for both of the companies. Verizon has shifted their focus back to the important segment of their business, which is wireless communications. And with wireless networks moving to 5G, they've been working strategically to invest in 5G infrastructure. The FCC put up 280 MHz radio frequency licenses up for auction. These frequencies, known as the C-band, can be used for 5G communications. But these frequencies weren't available for 5G until now because they were owned by the satellite TV industry. But not the small dishes that you see used by DirecTV, the old larger ones used in the 70s. There was a lot of demand that had been building up to repurpose these frequencies for 5G. So in January 2021, the FCC auctioned them off. Verizon spent $53 billion, which was the largest of any single carrier, on the newly available C-band spectrum licenses. Prior to this auction, Verizon's 5G frequencies have been concentrated in the low-band spectrum. These waves can travel long distances but don't carry data as efficiently. The high end of the 5G frequencies, called millimeter waves, has the fastest download speeds, but they only travel a few hundred yards. The C-band frequencies that Verizon purchased are the mid-band spectrum, offering boosted speeds at more manageable distances. The $53 billion Verizon spent doubled their mid-band 5G, and over the next couple of years, Verizon hopes to get these frequencies rolled out. By 2024, Verizon expects 250 million people to be covered by the C-band spectrum 5G, and it'll spend about $18 billion per year over the next 3 years for development. Okay, so now that we have an understanding of what's going on with Verizon's business, let's take a look at how they're doing financially. So starting off with Verizon's revenue and net worth, we can see the slow revenue growth I talked about earlier. Towards the first half of the decade, we see pretty steady growth. I think a lot of this can be attributed to the smartphone boom, which was still continuing through these years. But by around 2015, Verizon's growth seemed to stop, and today they're making about the same amount of money. When we look at the revenue versus expenses, we can see operationally, Verizon doesn't actually have a lot of costs associated with running their business. Their cost of services is actually fairly low relative to their revenue. So Verizon breaks this business down into two segments, but they actually reported a pretty substantial amount of their revenue in the corporate and other category, so I went ahead and included that as a third segment. So the first segment is the consumer group, which are their personal wireless and wired communication services. The second segment is the business group, which are business wired and wireless services, as well as other business services. And the third segment is the corporate group, which is the now sold Verizon Media Group. We can see the consumer segment is the largest portion of their business, making up the majority of their revenue and profits. We can also see that even over the last year, revenue has declined, but the consumer segment saw about the same amount of profit. We can also see that the corporate segment only made up a small amount of the revenue and was actually losing about $1 billion a year. Now for this video, I came up with a whole new chart idea to show you guys the balance sheet. On the left, we have the assets to liabilities, and on the right, we have debt to equity. So Verizon reported $353 billion in assets with about $9 billion in cash. They also reported $233 billion in liabilities and a pretty high $150 billion in debt. They also reported $78 billion in equity, which puts their debt to equity at just under 2, which isn't great for a company that's going to have to take on a lot of expenses related to building out 5G. Okay, so now that we have an idea of how the business is performing, let's take a look at what it's worth. So right now we can see the current forecasts have Verizon at roughly flat revenue and earnings growth going forward. The current forecasts for 2021 and 2023 are for them to earn about $134 billion in revenue and take in about $22 billion in profits. When we look at the revenue growth, we can see that they basically fluctuate around no growth, which is pretty much what we expected. And when we look at net income growth, we see a slightly more varied version of the same chart. I think a fair growth rate for Verizon is somewhere between -2% growth for the bottom end and about 2% growth for the top end. When we look at macrotrends.net, we can see that they have consistently traded between a PE of about 5 and 13. Also, we can see that the PE ratio of 5 in 2017 is a great example of why just looking at the PE by itself is a bad way to determine if a company is cheap or not. If we look at 2017, we can see that they had a huge bump in profits that year, which went away as soon as the year was over. The boost in profits was actually just from a temporary tax benefit that added about $13 billion in profits to the business. So a growth rate of -2% gives us a fair PE value of 7, and a growth rate of 2% gives us a fair PE value of 11. When we multiply the current and future earnings forecast by these PE values, we can see the stock is projected to continue to have the exact same value as today as it will in 2013. Now, what's not included on this chart is what the main appeal is for buying Verizon stock, and that's the dividend. As of now, the company pays out 4 times a year, and they're currently paying about 64 cents per share. So at today's $50 share price, the stock will pay you $2.56 to own it per year, which is about 5% of the cost. What's important with dividend companies is checking how safe their dividend is. You can do this by looking at how much they pay in dividends versus the earnings per share. So right now we can see that Verizon is paying a lot of its profits out in dividends, but the profits are up a decent amount this year, which gives them a lot more room to reinvest in the business. Right now, I think the dividend is safe. So right now, if you're looking to buy Verizon as an equity investment, or basically just looking to buy the stock while it's low and sell it while it's high, I don't think that Verizon right now is a good investment. I don't see the current share price having much upside at today's price and the forecasted earnings. Also, while 5G will be a big improvement for internet capabilities, I don't really see this as much of a game changer for Verizon stock. To me, it just seems like the new standard that they're going to have to meet, and I don't really see this adding much to their bottom line. The only way to look at Verizon stock is to see it like a corporate bond. But unlike most corporate bonds, the dividend isn't guaranteed, and you basically have to take on the same risk as any late maturity blue chip stock. Personally, I think there's just a lot better investments out there for the same level of risk, so I just don't really see Verizon as a great investment right now. If you are looking for a good defensive stock to invest in, with a safe future and good returns, a few weeks ago I made a video about Visa stock, and I highly recommend that you guys check it out. Personally, I was so impressed by Visa stock after doing the research for that video that I took out a pretty big position myself. Now, if you do want to check out the Visa video that I talked about earlier, click the link right up here. And as always, thanks for watching.